When the VIX is high, it is time to buy. When the VIX is low, it is time to go. In today's podcast, we're going to break down the VIX, which is Wall Street's fear index. And we're also going to talk about the winners and losers from the first quarter of 2025 and what that means for your retirement portfolios. Hello, everybody, and thank you for joining another episode of the Planning for Retirement podcast. My name is Kevin Lau. I am your host, and I'm also the lead financial planner at Imagine Financial Security. We help individuals over 50 with at least $1 million saved, maximize their retirement spending, minimize their lifetime tax bill, and worry less about the financial markets. If that describes you, make sure to follow our podcast and subscribe to our YouTube channel. We're putting out weekly retirement-related content specifically designed for you, who I like to call PFR Nation. So before we jump into today's topic, I just wanted to share a dad's dream come true here, a golf dad. So last week, I've got this guy in my club who's asked me to play golf a bunch of times, and I keep saying no, just because I just don't have free time right now to play a lot of golf. But, occasionally I'll get out in the range and play a little bit. But anyways, last Friday, my wife was taking my oldest son to his school's bro bash. So essentially, that's the mother-son equivalent of the daddy-daughter dance. So she was super excited to take Tristan, my oldest son, to the bro bash, and they did that. And so therefore, yours truly had my twins on Friday evening. But I get a little text message from my buddy at the club. He said, "Hey, do you want to play some golf after work? We're going to tee off at 6 p.m. And I said, "Well, can't do that. I've got my twin boys. Can't play golf today." And he said, "Why don't you bring your twins?" And I thought, okay, why not? Well, let's do this. They've never been on a golf course. They've been to the range with me, not necessarily hitting or practicing, but just kind of running around. And they've been to the putting green. They're actually pretty good putters, all three of my boys. But I brought their little set of clubs, put them on my golf cart, and they rode with me for 6 holes. And it was probably my favorite golf round of my lifetime. I've got to say that. It was honestly, like I said, a dream come true. When I was first having kids and thinking about, I've got a boy. Now I have 3 boys. My dream has been, I've got my dream foursome of the Lau boys, myself and my 3 boys. So again, had the twins out and we had a blast. And on the first tee, I didn't let them play out every shot, of course. It would have taken hours just to play 2 holes. But the first hole, I let them play every shot. And they just essentially dropped their ball near mine. And both of my boys, first tee ball, first swing at it, they hit the ball straight down the middle. Julian, that dude has a hockey swing. He's like my little Alex Ovechkin. And I mean, that kid, he slapped that ball. It probably went about 30 yards. Okay. The kid's 4. And it probably went about 30 yards straight down the middle. And they were having a blast. And now every day since last Friday, they've been asking, "Dad, when are we going to Black Creek?" So I'm very excited, proud papa moment. And you know what? That dream foursome just might come true one of these days. All right. So why don't we talk about the VIX? What is this fear index that I'm talking about? So this is one of those things that Wall Street, they track really the uncertainty of the markets over the future. And they use this index called the VIX index. And so when it is at its normal level, we'll call it around a 15. That's kind of like a normal range. When it gets up to maybe 30 or even above 30, there's a lot of fear in the markets, okay? And today, the VIX, okay, I'm recording this on April 9th, by the way. Okay, so this is Wednesday, April 9th. So I'm recording this almost a week before this episode comes out. So the VIX touched, let's see, what was it earlier today? It touched 50, okay? And at that point, when I started recording the episode, earlier today, this is actually my second recording because after I recorded, I turned off the episode and then I watched what happened with the market, and the S&P 500 ended the day 8.5% up. So it was up like almost 400 points. So anyways, the VIX hit 60 early today. And again, I go back to this saying that it's kind of near and dear to my heart. When the VIX is high, it is time to buy. When the VIX is low, it's time to go. Why that is because when there's a lot of fear in the markets, that's when the VIX is elevated. Typically, there's volatility. And what we know with volatility, when there is a downturn, oftentimes that brings about opportunities. I've talked about the Harvard study where they mentioned 51% of the best days in the S&P 500 happened during a bear market. Now, we're not in a bear market yet, and we have not touched the bear market in the S&P 500. The NASDAQ, we did. Okay, so there are buying opportunities now, and look what happened. Trump reversed course, did a 90-day pause on a lot of the tariffs. The 10% flat rate continued as is, but the markets rallied 8.5% in a single day. And it's just a friendly reminder that you do not want to invest based on how you're feeling. Because I'm telling you right now, we just wrapped up our first quarter reviews. my clients, we've been working with them for many, many years. So we've been training them on this one. I think they're finally at this point where we've been through enough ups and downs where they kind of know the process. They know we're going to stay disciplined. We're going to be unemotional. We have a repeatable process to rebalance and tax loss harvest. But I'm telling you right now, there is fear out there in the markets. I've been talking to other people. I've been listening to advisors. I've been watching what's posted on the forums, what's posted on the Facebook groups. People are very, very worried about the markets. And that's oftentimes that is the perfect time where you want to really dig in and kind of think about the Warren Buffett quote that I love to reference: be fearful when others are greedy and greedy when others are fearful. Okay. And so again, the VIX hit I think it was about 51 was the high point today. Just for frame of reference, the VIX hit 66 in March of 2020. So we were almost at that panic level of uncertainty and fear. That period of time, March of 2020, the market sold off a lot more dramatically, 34% in the course of about a 6-week period. A lot more dramatic than this recent sell-off. And I don't know if it's because the media likes to pile on Trump and Trump's just front and center, probably a combination of the two. I think he probably needs to kind of temper it down a little bit with tweeting every thought that he has around tariffs or threats of tariffs. The markets don't like uncertainty, but that's just who he is. That's the way he does business. And so I'm going to look at this long term. I'm going to wait and see what happens with this 90-day pause, what ultimately happens with what tariffs are staying in place, what's long term. Obviously, this trade war with China seems like it's escalating even further. I think it's now north of 130% tariff rate on China as I'm recording this. But that's just who Trump is. And again, I'm going to trust him and his people to do the right thing for our country. Okay. But again, looking back on the VIX, it is one of those things where if you did buy into the markets, or if you did rebalance into the markets when the VIX hit the high point, you were a genius. Okay. I look back in October of 2008, the VIX hit 89. The VIX hit 89. So it was almost close, not 2 times, but it was a pretty significant multiple of where the VIX hit today. And again, if you bought it in October 2008, you felt pretty good about that because the market had sold off pretty dramatically from the high point of October of 2007. So again, if you are disciplined and you stick to a process, long term, you can consistently buy low and sell high, which is ultimately that's what you want to do. That's how you want to invest. You don't want to be selling when the market's down like yesterday. Okay, yesterday the market's down. Year to date it was down about 15%. You don't want to do that. You don't want to bail out of your strategy. And this is a big part of what I'm seeing people do on the street, not necessarily our clientele. I think we've done a really good job coaching our clients and helping them understand why we're investing. We're investing for their retirement income plan. We're not investing for fun. We're not gambling just for fun. We are investing for a specific purpose. Achieve work optional, fire their boss, generate a retirement income, leave a financial legacy. Okay, these are the things we're investing for. And we understand that the ups and downs of the market are just par for the course. But you were a genius if you put a lot of money in the markets when the VIX hits a high point. So just kind of keep that in the back of your mind. When the markets are going volatile, check out the VIX, see what the VIX is doing. And if all of a sudden you see this VIX elevating at 30, 35, 40, you could bet yourself at some point in time, the market's going to recover. And you look back at that period of time, that was a great time to buy into the markets. But with our clientele, again, the 50 plus crowd approaching retirement, recently retired, and most of you that are listening to this podcast, you're not interested in betting the farm on a potential rally when it absolutely could turn the other way. Okay. But it's just a friendly reminder to never try to outsmart the markets. Okay. These markets are very irrational in the short term. Like these traders that are moving the market, they oftentimes shoot first and ask questions later. Long-term investors, it's more important about time in the market as opposed to timing the market. Remember that. Time in the market always trumps timing the market. So why don't we talk about some of the winners and losers in the first quarter? And I'm going to go in order from worst to best. And so we're going to kick it off with small cap stocks down 9.5% year to date. Not surprising, small caps have been the second best performing asset class over the last 15 years, right behind large cap stocks. Small cap stocks actually, generally speaking, outperform large cap stocks in the long run. The S&P 500 oftentimes returns on average about 10%. Small caps usually about 12 to 13%. So it's kind of flip-flop over the last 15 years, but small cap stocks have gotten hammered so far year to date, largely because these tariffs are probably going to impact some of these smaller size companies just because they don't have the scale and the size and the power and the capital like some of these mega cap or large cap companies do. But they're down 9.5% year to date. Again, this is the first quarter. Blood has happened since then. Okay. So there's been blood in the water since the start of the second quarter. So these numbers are even worse. as I record this on April 9th. But the second worst performing asset class is large US stocks, which is essentially the S&P 500 down 4.3% year to date. Now, this was the best performing asset class over the last 2 years. And really looking over the last 15 years, it's been the top dog. It's been outperforming its historical average by about 300 basis points. And it's one of those things I'm just warning clients, like it's, the recency bias. Everyone is now overloaded into big tech, into the S&P 500, and very underexposed into some of the other asset classes and things. If you believe in the law of averages and long-term, things that are outperforming will oftentimes come back to earth. You might say, you know what, maybe it makes sense to take some of the risk off the table from the small caps and from the mega cap companies in the US and potentially diversify out. We'll talk about that here in just a bit. Okay, those are the two losers. Those are the only two asset classes that were actually down in the first quarter to date as of March 31. Now, the third worst asset class is high yield bonds at 0.9%. I'm going to kind of run through these pretty quickly. Cash 1.1%, REITs or real estate investment trusts, positive 2.8%. Okay, so typically inflationary periods or periods of uncertainty, oftentimes real assets can do quite well. And therefore, REITs have done quite well so far year to date. But look at this one. Investment grade bonds, the aggregate bond index, positive 2.8% quarter to date. That's tracking for a rate of return, an annual rate of return of about 9-10%. Okay. And again, I did this episode bullish on bonds specifically for this reason, because typically when you have periods of volatility and uncertainty, and also couple that with the fact that interest rates could be on the downturn in 2025, we could see bonds starting to pop, because if you look at across the board with all asset classes, it's been the third worst asset class, relatively speaking. It's only better in cash and high yield bonds. So a significant underperformer is investment grade bonds over the last 15 years. But we could see that tide turning again. Think about the law of averages. When things are typically underperforming their historical average, typically they can outperform in the future. But there's no crystal ball. I'm not predicting the future saying I want to be all in on bonds. That's not what I'm saying. I'm just pointing out that bonds so far quarter to date doing pretty well. But look at the top two asset classes. Number two, emerging markets at positive 3%. And then number one, the top spot, international developed markets. So the top two asset classes, international stocks. Listen to me right now. I can tell you firsthand, most of our clients, most people I talk to, most advisors have been very bearish on international stocks for many, many years, really since the Great Recession, because they've been dramatically underperforming their historical averages. In fact, they've been lagging both small cap and large cap stocks over the last 15 years by 500 basis points and 800 basis points, respectively. So, it's one of those things, again, the recency bias. Many people kind of look at this and say, why would I own international stocks? Okay. But if you remember, before the Great Recession, 2000 to 2010 is what we like to call the lost decade. And this is where the S&P 500 failed to regenerate a positive rate of return during that 10-year period. That had never happened before. However, if you were well diversified into a portfolio with not only US stocks, but also small cap stocks, international stocks, and fixed income, you actually generated a positive return in the 5% range, even though we had two big sell-offs in the tech bubble bursting as well as the Great Recession. Okay. So it's just a friendly reminder. I'm not saying international is just going to be the top dog forever, but I'm saying when things typically are out of favor, they can sort of come up for air and typically or could potentially outperform in the years ahead. So you want to make sure you have adequate exposure. And we're going to talk a little about that, later on in this podcast. So we've been wrapping up first quarter reviews with clients, and it's been a busy few months, to say the least, and especially over the last couple of weeks, with all the market volatility. And I'm just telling you, I'm definitely feeling this firsthand, despite the fact that I said earlier, I'm kind of pumping my chest that, hey, I think we've coached our clients pretty well over the years as to what our process is and that we're going to be sticking to a process and we're not going to be acting on emotion. But I've definitely been feeling it from clients a little bit more, a few more emails, a few more phone calls, even some text messages, just feeling the concerns with all of the uncertainty in the market. The market does not like uncertainty. And I think that's a big reason why there's so much volatility in the market, is because the tariff policies, there's just so many question marks here. Okay. And so I have several questions that I have given the current economic backdrop. And I think the biggest question that I think many of you have and that I have as well is, how long are these tariffs really going to be in place? Are they a negotiating tactic to reduce our trade deficits? Or is this a permanent thing to completely reform global trade policies over the last 40 years and basically bring manufacturing home? And for me, it kind of feels like a negotiating tactic, because especially today, the pause for 90 days after the tariffs went into effect today, it feels like a negotiating tactic. And obviously, Trump is saying that 75 countries have called him and, are trying to make a deal. Hopefully that's true, because I don't think anyone wants tariffs that are 30, 40%. I mean, that's not going to be good for inflation. And it's also not going to be good for just the American businesses that rely on a lot of these imports to manufacture their goods here in the US. But listen, long term, if we have a plan to bring manufacturing home, and if we can do that cost effectively and keep inflation in check and bring jobs home, I'm all for it. But I think slapping these tariffs aggressively and unexpectedly with so much uncertainty, the markets don't like that for a reason, okay? And I think the next question that I have is, how much does the trade deficit actually matter? Because I ask this because for so many years, people have been just calling out these politicians, worried about the trade deficits. Look at all of our spending. We now have a trade deficit in excess of $1 trillion a year, and that's going to continue to grow unless we fix the trade deficits that we have with our trade partners. So my question is, does that not matter anymore? Okay, and the reason I ask that is because, is it just the person that's in office that is trying to enact change? That's why these policies are bad? What if these policies actually work? What if they actually reduce our trade deficit and actually we work to fix the debt that we have in the United States? Again, it's not going to impact folks that are 80 years old or 90 years old. I mean, they're not concerned about 20 to 30 years down the road. Of course, they're probably worried about their kids or grandkids, but I'm thinking about folks that are 45, 55, 60 years old that have another 30, 40 plus years on this planet. My question is, does the deficit matter anymore? Does our trade deficit matter? Because if it does, why don't we wait and see if these policies actually play out and what policies actually do stay versus what policies are more for negotiating tactics? That's sort of a question I would just throw out to all of you listeners out there. Next question I have is, what is going to be the fiscal and policy responses of this administration? Okay, is the Fed going to start to cut rates sooner to kind of temper the recession concerns? The recession risk is now upwards of 45%. Okay, so does the Fed go 3 rate cuts? Do they cut earlier than expected? I don't think they were in a big hurry to cut rates based on Powell and all the other Fed talk over the last few weeks. It seems like they were pretty comfortable delaying the Fed cuts, but now are they going to cut earlier given that inflation or that their recession risk indicator is upwards of 45% at this point in time? And then another big policy question mark is, will the Tax Cuts and Jobs Act get extended and made or potentially made permanent? Because ultimately, the Tax Cuts and Jobs Act, they are set to sunset at the end of 2025 unless something changes. All of the experts out there, myself included, I'm pretty confident they will at least get extended, if not potentially made permanent. And is that going to rally the markets? I think it could absolutely be positive for the markets. And then my final question on this one is, with everything going on, is which politicians, which of them sold off before these tariff policies were announced? And then when did they buy back in? And then why are politicians even allowed to trade individual stocks in the first place? It's really beyond my comprehension. It seems like insider trading to me. Who am I? But again, how are they able to place trades on individual stocks, individual companies or sectors that their policies are directly impacting? So I want to see the trade reports over the next few months of these politicians that sold off at the end of March. And I really want to dive into that one. So maybe I don't want to know. Maybe I want to bury my head on the sand on that one. But now, what are some tactical moves that we're making for our clients in 2025? And what have we done so far year to date? Because I think hopefully this will shed some light in terms of what specific action items you might want to consider. And again, this is not advice. This is not tax advice or investment advice. You need to make sure you consult your own advisors and you need to have a game plan before you put any of these in place. But the first thing I'm going to recommend is really at the core of what we've been talking about, which is making sure you have a plan and making sure you're sticking to your plan during this period of uncertainty. Okay, because again, I'm having conversations with my clients. They know our plan. They know we're going to stick to the plan. But how many of you out there are trying to potentially deviate from your game plan? Or do you not even have a game plan? Okay. And what I mean by game plan is, do you have an investment strategy and an income plan that is directly aligned with your risk tolerance and your specific retirement objectives to generate cash flow, to minimize your lifetime tax bill, and ultimately potentially leave a financial legacy? Okay, so if your game plan, let's say your investment targets are 75% in equities, 25% fixed income. Let's say that is the optimal path for you based on your specific objectives, your specific risk tolerance. Well, if you looked at your statement, not the value obviously that's going to be painful. But if your target was 75% equities, 25% fixed income, if you look at the percentage distribution today, as I'm recording this, it may be closer to 70% equities and 30% fixed income. Because again, remember the fixed income, that's been one of the lead dogs so far year to date. Equities have been at the bottom. Okay, especially US equities. So if you're sticking to your plan, that means you are selling off some of your bonds to get it back to the 25% target, and you're buying equities to get that back up to the 75% target. Okay. It's not, oh my gosh, I'm going to bail because I don't know what's going to happen. There's so much uncertainty in the markets. The media is telling me we're going to get into a recession. Therefore, I'm going to move the cash. That's not sticking to the game plan. And so that is my first plea to all of you is please stick with your game plan. I've been in this business for over 16 years. I've had so many of these conversations over all the downturns, 2008, 2009, 2012, 2018, 2020, 2022, now 2025. These things happen pretty frequently, okay? And I understand that it never feels good. But if you can stick to a process and rebalance to your specific investment targets, that's going to help you again consistently buy low and sell high. The second plea to you is you really need to evaluate your strategy from an income standpoint, especially if you're retired or nearing retirement, to really determine, okay, what's your cash flow plan if stocks are potentially going to sell off even further, or potentially we enter a prolonged bear market or a prolonged downturn or a recession, okay? And I think you can really lean on that fixed income as we go forward. Because again, coupon rates on high quality investment grade bonds are now north of 4%. I believe they're going to be fairly stable, especially as we continue to have this volatility. This is a safe haven for investors. If they're going to sell out of stocks, they're going to have to go somewhere. They're going to typically buy out US treasuries or high quality corporate bonds. So if you have fixed income as your part of your portfolio, really map out, okay, how many years of my cash flow do I have in bonds? Okay, let's say you need $100,000 from your portfolio. Maybe you have $500,000 in fixed income, okay? Therefore, you have at least 5 years of your cash flow needs locked and loaded in bonds, high quality investment grade bonds. So if we go through a downturn that lasts 3, 4, 5 years, you have 5 years of your cash flows. Not necessarily that's guaranteed, but very highly probable to be able to generate those cash flows to let the stocks weather the storm and let them recover. Again, to avoid selling stocks in a downturn. That's what I'm trying to educate all of you on is you don't want to sell stocks when they're down. You want to sell stocks when they're up. Okay, when things are way overvalued, you want to take some of those gains off the table. When things are undervalued, like probably before today's market opened, that's the time to buy. And when it would come to generating cash flows in retirement, you're going to be consistently selling something to generate that monthly or quarterly cash flow. So if you go through a prolonged downturn in stocks, you need a place to go for income, and therefore the fixed income comes into play. The third thing I'd highly recommend you do is really review your equity exposure and making sure you're diversifying your equity exposure beyond the United States, beyond US large cap stocks, into the mid caps, into the small caps, into the real estate side, into emerging markets, into international stocks. Having a well thought out diversified portfolio will protect you if we go through a prolonged downturn in US equities, like we saw from 2000 to 2009. Yes, we had a nice little pop today, but ultimately, who knows if volatility isn't going to be continuing to head in 2025. I don't have a crystal ball. I'm not a betting man. I'm not going to bet my client's portfolio on one particular asset class. So I'm going to highly recommend, even though the recency bias might tell you no international, no small cap, let's just stick with the large mega cap companies that could come out of favor if we go through a sort of a continued period like we saw in the first quarter of 2025. So just keep that in mind and make sure you have a well-diversified allocation beyond just large cap US equities. And the last strategy we are implementing is heavy tax loss harvesting. Okay. And this is one of the beauties. This is one of the blessings of market volatility is when markets sell off, typically you're going to have unrealized gains in your portfolio. And I'm talking about outside of your retirement accounts. So these are taxable brokerage accounts or trust accounts. And if you have unrealized losses, that could be an opportunity to realize those losses and actually sell when the market is down. And you might just say, well, Kevin, you just told me not to sell when the market's down. Well, tax loss harvesting involves realizing the loss because if it's just a paper loss, it's not going to help you from a tax perspective. So selling something at a loss, now you're building up this war chest of losses that you can use to offset capital gains, either in the current year or in years ahead using carry forward losses, or you can deduct up to $3,000 against your ordinary income if you don't have any capital gains. So we've been harvesting multiple 5 figures of losses for many of our clients and just building up that war chest to prepare for capital gains down the road, distributions, or simply offsetting ordinary income. But what you'll do once you realize that paper loss and you sell that particular investment, what you're going to want to go ahead and do is replace it with another investment that's not the same. You can't buy the same investment and you can't buy something that's substantially identical, but you can buy something that's similar. Okay. So maybe you've got a US equity fund that you have with Schwab and you replace that with a US equity fund that's maybe at Fidelity or Vanguard. Now you've got a similar exposure to some of the holdings that Schwab fund had, but you've got the paper loss. And then when the markets recover, like we saw today, that 8.5% bump, you still now have that exposure to equity so you can participate in the rally. But now you've got those losses locked in for 2025 so far, and you can continue to look for those opportunities throughout the year ahead. So really important strategy is tax loss harvesting and really minimizing your lifetime tax bill with this particular investment strategy. So great opportunity to do this. We haven't really seen these opportunities since 2022. So we jumped all over it Friday and Monday of this past week and really took advantage of that for our clients. Because again, sometimes people tend to bury their head in the sand when markets are down. Oftentimes like, I want to ignore the markets. I don't want to look at my statement. This is a mistake. Okay. If you're not managing your investment portfolio properly, you are going to miss out on tax loss harvesting opportunities. And sometimes it doesn't show up like it did today. Sometimes it's not a massive sell-off in the market. Sometimes it just might be a 1 or 2 or 3% dip. And you can slowly and steadily build up your war chest of realized losses that you can use to, again, offset gains or even reduce your ordinary income into the future. So I hope you all found this helpful. That's it for today, everybody. And again, I cannot emphasize this enough is having a game plan is the most important thing. And so sticking to your game plan, whatever that game plan looks like from an investment perspective, from an income perspective, from a tax planning perspective, is so critical during times of volatility because it's very easy to get caught up in emotions. Again, the media, they play into this so beautifully. They are absolute experts when it comes to manipulating people's feelings. And so it's very easy to kind of watch the news and tune in and sort of buy into the hype. But then all of a sudden, the market could rally 8.5% in a positive direction. So again, sticking to your game plan is so important. And if you don't have a game plan, if you're sort of investing without a lot of direction, you don't really know what your retirement income strategy looks like, or maybe you want a second look at it. Maybe you've been doing quite well, but you're like, hey, I probably should get a second set of eyes from someone or a team that understands this and does this on a day-to-day basis. We'd love to help you. I mean, this is what I've said before in the podcast. I'm not even kidding you. Every single new client we bring on must be a podcast listener. And I am emphasizing that so much because that way they can kind of learn the way we think, the way we do things, our philosophies before they hire us. And I think that's a win-win situation. So new clients must be podcast listeners. And so if you are a podcast listener and you fit our criteria, make sure to check out the retirement readiness questionnaire and fill that out. Start there, or just visit our website, www.imaginefinancialsecurity.com. We would love to help you. This is what we do for a living. I'm not a professional podcaster. I just like talking about these strategies because they're so important. And I don't think enough people are hearing the advice that they should be hearing. Many people get their retirement advice from the news, from the media, not who you should be listening to, especially during these times of volatility. So again, make sure to follow our podcast, subscribe to the YouTube channel. Next week on the podcast, I'm going to be doing another volume of the retirement whiteboard breakdown. That's going to be a very exciting case because it's actually about a situation where you should not wait to spend on your Roth. Like the traditional investment advice and retirement income advice is spend your taxable account first, then tax deferred, then tax free. This particular situation is not that. It's actually spend your tax-free balance right away. And so that's, I think, a case that you're really going to be interested in. So again, make sure to follow the podcast, make sure to subscribe to the YouTube channel, make sure to leave a 5-star review. If you're finding value in the content we're putting out, that really helps us reach more people, impact more people. That's what we're trying to do. This is what we do for a living. And so we would love for you to do that. And again, last but not least, I'll ask you to just share this podcast with a friend or family member again, because the reach is tough. There's a lot of podcasts out there. So I'm not going to pretend like we're reaching millions of people daily. But if you are finding value in what we're doing and you know you have a friend or a family member that's probably in a similar situation as you, share this podcast episode with them. They will greatly appreciate that. I promise you that, or I hope so. So that's really it for today, everybody. I hope you guys enjoyed the Masters. I'm really looking forward to diving into the Masters. Like I said, this is things are teeing off tomorrow. I'm a golf nerd, so super excited to dive into the Masters. I hope it's a good one. Until next week, this is Kevin Lau signing off.